Jack, I'm going to turn it over to you and take it away.
Okay, thank you, Heather. Yes, our Blizzard version. So we'll get going here. I'm going to talk. Is that coming through? I got to switch that, I guess. There we go. I'm going to talk some input costs, and guess we'll just get right at it. Contact information, and then I just have corn and soybeans, and then I've broken them down across the state to different regions, really pretty well east to west, the higher production being in the east and the mid, and then lower further west. It just follows the rainfall and soil types. And I just picked corn and beans. That's not to say that other crops aren't viable, but that's just what we're going to discuss today. I picked just some current bids that were out earlier this week. And as we see in the east, we got a little higher bids as you move to the center, maybe not quite as high. And of course, basis will determine a lot of that. Sometimes you get in further west, if they need some corn or beans to move, then they'll bid that up. But that's what was taking place for 23 new crop bids. So next fall, kind of where the bids were at. Just a lot of numbers go on there. You can see we're about $657 on direct cost. I picked out some of the top ones: seed, fertilizer, pesticides. Other is fuel, repairs, all of it kind of thrown together. And then I highlighted interest because that's going to be something that's going to really come to the front, I feel, in this next year. You know, we're probably going from maybe a 5 to 6 operating line of credit interest rate to maybe 9%. And Matt's going to talk more on that coming up. So there's where our costs kind of fall out. A lot of on the seed, we'll just pick them apart here and talk about them a little bit. Seed is kind of held steady the last few years, and this year with increased selling prices, I think the seed companies felt that they could boost their take a little bit or boost prices some. So we'll see probably a 10 to 15%, at least on corn seed, increase. Beans, I did price some beans earlier this fall for seed beans for next spring, and those were kind of held about the same as they were in 22. Fertilizer is up over 21 prices, but probably a little bit less maybe than 22. And we'll talk more on fertilizer going forward. Pesticides are high, you know, that's everything thrown in there. Can be weed control, weed control, insects, fungicide is the word I was looking for if they do a fungicide treatment on them. So all of that is thrown in there. And then, like I said, interest rates being higher. Then I just have machinery ownership costs down below, and that really depends on if we've made some trades recently, whether that moves or doesn't move, and then the management fee that is generally kind of taken out. So total non-land cost of $781 on the high and $450 on the low side. There's land costs that I threw in, and I took our current rental rates for high production areas and then just adjusted accordingly for other levels of production, and then increased about 10% over what they were in the last report. So if we're in that high production area, got good yields and that for the 555 for a price, you know, we still have a pretty good return on corn. Beans, they're probably yielding more than that 55 in those high production areas. Otherwise, if we're at that level and that price, it's not going to necessarily be profitable, profit over all cost, but still covering the non-land cost easy. And then it just carries across with the middle production level and the lower production. I guess here just showing the price per bushel to cover the non-land cost and then the total. You know, we're getting very close. Well, we're definitely over 450 or 470 even. Really, you could say almost close to $5 to cover all cost. So we've added more cost, you know, in a time when interest rates are increasing, and it's going to be a tighter year right now, or it looks like it in 23 versus 22. So just continuing on with those historical, seed took a big jump in 14 before, and those percentages that I'm showing on the screen are a percent of growth. So for corn. So if you took your total dollars corn and divided that into seed cost, it was at 14% in 2013. Before that, and I know I'm going back quite a bit, that ran around 11 to 12%. And then it took that jump, stayed above until 15, and then kind of went down at 15 and went down in 20, kind of 21. And now it's going back up. Yeah. So in talking with suppliers this fall, probably a 10 to 15% increase over the 22 prices. And then here we'll switch to fertilizer. It increased to almost 17% of gross in 2012. Before that, it had run between 14 and 15 and stayed above 16% until 2020. It did fall a little bit in 2020 and 21. Then we had our large increase, and we'll look closer at fertilizer in the next couple of slides. Land moved to 30% in 2014. It adjusted a little bit lower in 20 and 21, and I would see it increasing in 23, that landlords will be asking for a rent increase. These numbers are taken from Finbin, and it's farms at 1,000 to 2,000 acres in South Dakota, North Dakota, Nebraska, and Minnesota. So these are where these numbers are coming from when I'm talking about a percent of gross. The machinery moved to 18% in 2013. It lowered in 20 and 21. And in talking with manufacturers and suppliers of equipment, probably a 25% increase in, you know, repairs, maybe more, and or ownership of machinery. And a management fee, guys tend to kind of adjust that by the level of net that they're able to achieve on it. So it kind of flows with a higher net, tend to take a little higher percentage, and we'll see where that falls out. I'm thinking interest rates are going to be close to at least 1.5 to 2 times higher than they were in 22, probably 4 to 5 points. If you had a $500,000 line of credit, you know, we're talking an extra 20,000. That's without any input costs going up. So interest rates really probably becoming more important, and more important, that working capital position. So they're just showing a graph of the top five costs that I have listed. I got 1,000 to 2,000 acre farms and a 2,000 to 5,000 acre farms. Still with that same database of South Dakota, North Dakota, Nebraska, and Minnesota. And then I took their average selling price that they had sold for in those years. So we can see where it was tight, and everybody knows, you know, after our big run up in 12 and 13, the things got tighter and, you know, it was a little tougher. And now we've had that big increase in price. And of course, our inputs probably following that up. Switching to fertilizer, urea is kind of the surprise, quite a bit cheaper than other forms of N. And this is taken from StoneX, and it's just urea's price compared to new crop corn. So it's fallen back down from where it was in that earlier time frame of the when it took its big run up, getting more back in line, especially on urea. And urea is probably 40 to 50 cents less than per pound, less than ammonia for a price of N. And that will probably have to adjust, you know, either, you know, each of those will move back together, closer together as we move into spring and see where our demand really is in the US. So things that are bullish for price of the fertilizer, Europe has started producing some of their natural gas fell in price, so they started back up in producing some. They're not at full capacity, probably running 30 to 40% maybe. So that is bullish. There's talk that China will ban exports again starting in January. Right now, they're shipping some or making it available. And the other one that current urea is cheap versus corn and other N sources. It also fits a bearish price for fertilizer that the European production is resuming. So if natural gas would continue to fall, and that would encourage more production out of Europe, then that would be bearish for the price of fertilizer. If China decides not to ban and would export more fertilizer, that would also be bearish or good for producers in fertilizer, not producers of fertilizer, but users of fertilizer, I should say. India usually makes big purchases or tenders, and they move that up by a couple months. So that kind of took market by surprise. And what happens now? Does that mean, okay, they filled their order or tender, and now is there going to be a time frame where nobody's wanting it or not as much as is demanded? Switching to phosphates, a lot of acres probably to be planted in the US, probably 92 to 94 million acres of corn. So demand that way is pretty solid. Our North American logistics to get it upstream are poor, both on the river and possibility of railroads or railroads moving slow. You know, on the barge traffic, they're moving some, but they got to go lighter loads and they can't use as big a barges. So slow to move and just not able to move it as efficiently. And this kind of been falling, so the grain to phosphate ratios are improving, which would help increase demand. Bearish, it's been falling the last few months or since actual spring in the US. So current trend is your friend. Farmers had probably pretty good year, even if you didn't produce a crop. For the most part, with prices going up and decent crop insurance, revenues probably look pretty good for the farm. And then some fall applicators look to be waiting until winter or spring. And potash, is still large demand. Again, a lot of acres available or probably being planted this spring coming up. Uncertain on Russia and Belarus exports. They're blocking some of those exports from coming out of there, and farmers had a good year. So if they don't want to buy equipment and maybe need to prepay some things for taxes, they could be looking to buy some fertilizer. Again, trend is a friend for lower. They're higher than historical, so it's an easy place to cut for farmers, and that would be negative towards fertilizer prices. There's a Jason Clark, Dr. Clark did a good job of presenting fertility on our November economic dialogue. So if you haven't seen that, be sure and take a look at that. And he talks about where we quickly reached that peak of N application and other fertilizers. So it's a good watch if you haven't had a chance to see it. Switching to land, and this is our gross value of land to rent, gross rent to value, I should say. So it's and we're not taking out any property taxes, so it's not quite really a cap rate, but could be thought of similar to that. And that's down below 3%, both for the cropland, non-irrigated cropland, and pasture. And as we see, when interest rates were higher, where that was at. So that'll be interesting as we move forward. Land values have not really backed off much, which is, I think, kind of surprising due to the interest rate increases, but maybe that longer term hasn't increased fast enough yet to slow our land values. At some point it has to. Got a lot going on in this slide, but we have interest rates going down here. This would be our rent that's paid per acre. When I started this was kind of where rent was, and this is where interest rates were. So that being the 0. And then if we move up by 0.5 or half a percent, and then showing where those land values would go to. And then this is be the change in it. So even if we went up some, we could still see land values going up, especially if our rents have increased. And some of the rents, on that high productive ground are getting into this level and or higher. So even though interest rates are going up, we could still see our land values appreciating here for a little bit anyway. So that'll also be interesting in our land market situation. So now just taking a look at machinery costs per bushel of corn yield. And I've got it broke out. So these would be the mid 20% in that as far as profit is concerned for the 1,000 to 2,000 acre farm. Again, North Dakota, South Dakota, Nebraska, and Minnesota farms. And then a 2,000 to 5,000 acre farm, and at the mid level of net income. So we can see what it's costing per bushel of corn yield for machinery. We're a little over $1, or right at $1, I should say, for the 1,000 to 2,000 acre farm, and right at 95 cents for the larger farm. Still not maybe peaked out as much as we have to the in our last big run up in the grain prices of 11 and 12, but it is going up. I think a big thing in the machinery is availability. And talk to some dealers and manufacturers this last week on machinery, and they are really limited. They're limited on the amount of equipment, new equipment that they can get. A lot of them can't even order for the next year on certain pieces of equipment. It's not even available for them to order from the manufacturer. And then on the manufacturer side, in the factories, tough to find labor, and paying close to 60,000 for a manufacturer in the plant, in a machinery plant, and they can't fill the position. So it's really, if you guys are thinking of new machinery, you got to really stretch that timeline out in order to think about getting it filled. This is just taking working capital, so our current assets minus current liabilities, and dividing by our gross revenue. Just kind of a way to measure that liquidity and keep track of where working capital is compared to our gross revenue. So this again is those 1,000 to 2,000 acre farms in those states, and really done a good job of probably keeping that at a decent level, at least through 21. I would anticipate that also probably going up in 22, but it's really key, I feel, to managing through these times when input prices are increasing and possible a decrease in our output price. You know, just with that uncertainty, that working capital position, a strong position, allows us to take advantage of any opportunity that might arise. And then also as a defense tool if we have a poor yield year or if prices fall out on us. I see financial management as increasing importance. It's we haven't had to worry about that line item of interest expense, gosh, for a long time. And as interest rates increase and costs increase, that will be key or more important than it has been in recent years, or at least the last 5 to 10. Working capital provides that safety net for volatility that we talked about. One thing that guys can do is keep a rolling cash flow and monitor their budgeted amount to their actual amount, and then make adjustments as needed. Either the ability to take advantage of opportunities or head off things that were unexpected. So those are kind of key. And with fertilizer, just wanted to mention maybe book some of that as we have come down in prices, but we could also see it fall into the spring too. So maybe spread that out. The other thing would be to, if we're buying at a high price level, to go ahead and sell grain against that, so you're not caught in that trap of a high input price and lower commodity price. That's what I have.
Okay, any questions? Quick, or we want to roll into Matt's presentation and then we can do questions at the end? Okay, it looks like you go, Matt, and we will do questions at the end.
All right, can you hear me all right?
And
All right.
Notes view.
Yep, just a second.
Okay.
How's that?
Better.
All right. So I had some good intentions for this month's dialogue. Most of them centered around me trying to gather up some of the stuff that I cover in our ag finance class. And so I grabbed a little bit of this and that from stuff that I shared with students this fall. And most of it centered around the dramatic change we've had in the interest rate environment. So get to some stuff and then we'll dig into the rates a little bit. So looking at lender surveys, if there's questions or something, please just chime in. Let's see. There we go. This is from a American Bankers Association survey from early in the fall. And it just asked the lender's top concern for producers. And you see the number one thing up there is other inflationary pressures. So Jack talking about input costs, it fits in well. It's like the cost increases that producers have seen is carrying over, and it's a big concern for lenders, and it's a bigger concern than liquidity or the farm income levels. Now you've also had a pretty good run up in farm income throughout the year, so that's helped quite a bit. If we look at top concerns facing that lenders themselves face, their top concern was interest rate volatility. So this is back, let's say July and August, you're surveyed, you're thinking, what is the Fed going to do with rates? Because what's that going to do to our costs, cost of funds that we in turn have to pass on to our borrowers, farmers and ranchers in this case. So that interest rate volatility, that sort of knocked out lender competition, which has sort of consistently been the top concern in that interest competition type of environment. So just thought I'd share those because the class found it interesting too, as we talked about how banks seem to or continue to have a fair amount of loanable funds available. So we don't have anything like a shortage of ability to borrow. It's, are there enough good loans to be made? And that also echoes what Jack said about working capital is in good shape. So farmers have adequate working capital. They're having deposits. They're not taking out as big of an operating loan. So the banks are sitting on cash and what are loanable funds. And they're concerned about the interest rate environment going forward. I included this, I debated, but I left it in there anyway. And I'm like, I challenged my class a little bit with it. It asks ag bankers. So there's more than just, in addition to ag bankers, you'd have insurance companies lending to agriculture and cooperatives indirectly lending or directly lending to agriculture, so indirectly competing with banks. So this is just asking ag banks, have your business practices changed as the farm economy has fluctuated or interest rates increase? And you see the bigger share of their business practices, they say that their business practices haven't changed, but then when asked about what the competitors are doing, they tend to say that their competitors have eased underwriting standards. So I challenged the class with this. I'm like, how could this be that the majority of banks say that we haven't done anything differently, but they're all saying that the competition has done something differently. So if we just surveyed ag bankers, or if the survey had only been done of ag bankers about other ag bankers, the commercial banking sector, it would raise eyebrows. How can we say that the competition's getting having looser standards or lowering the hurdle to borrow, and at the same time we haven't changed. So the percentages would need to come out similar if everybody was answering honestly. And there's nothing nefarious going on. I don't suspect, but it was interesting to challenge a class with it, because what could be happening is ag banks are holding steady. They haven't done anything to change anything, but some of their other competitors could have been easing standards or loosening things, trying to extend more loans, make loans, and that could be perceived as loosening standards. So I'm a commercial bank, I can't approve this, but if you go across to a different lending entity, they might still make, the competitor might still make the loan. So that's a possible explanation for what's otherwise a disparity in terms of, this is what we're doing, this is what our competitors doing, and the competitors are saying we're not doing any changes. So yeah, I found it interesting. Focusing in a little bit more directly on some of the input prices, you can see down in the bottom left-hand corner of this, this is hot off the press from the Economic Research Service. This is from December, or as of December 1st. So this is ERS big picture look at the whole farm sector for the United States, what's happening with major inputs from this year versus last year. So this is projected for calendar year 2022 for all farms and ranches across the United States. And you can see here that with the darker blue bars there for 2022, everything except seed has had an increase relative to 2021. So feed, as corn and soybean meal prices are higher, the feed purchase expense goes up, fertilizer expense goes up, slight increase in labor. But you can see there in the middle that already for 2022, interest moved from just under $20 billion for the entire farming and ranching sector to getting close to or approaching $30 billion. So if you think about that in an increased level, so that means the average farm would see about say a 40% increase in interest expense already in 22 compared to 21. But the way operating loans work and the way the financing plays out, the rate increases, including the increase of another 0.5% earlier this week by the Federal Reserve Bank, you're going to have 2023 really starting to show the cumulative effects of the increase in the interest rates. So again, this is just looking 2022, the projections for 2022 compared to 2021. Also in that ERS report or summary was the a breakdown of what's happening with farm sector debt. So this would be all lenders, the total real estate debt and total non-real estate debt. And you can see that sort of the big driver really over the last 20 years has been real estate. So as property values or land values increase, even though the share or a given percent of the land that's got a loan underneath it or backing it, that really hasn't changed much. But as property values have risen, real estate debt has risen as well. So non-real estate debt hasn't fluctuated as much, but that real estate debt continues to grow. And you can see it exceeds the, on an inflation adjusted level, it's exceeded the level from the early 1980s a couple of years ago already. So, and I think the last couple of years here we've exceeded the total farm debt on a inflation adjusted basis. It's exceeding those levels from the early 1980s. So just for perspective there. And then again with the class, Historically, if you see down at the bottom, it says archive data from discontinued ag finance data book. Kind of dry, but the ag finance data book was published for about 30 consecutive years, and gave a pretty broad overview of different ag bank information and interest rate information. And during the last few years, that's been adjusted. I think in 2020, they switched to a new format. And historically, I had my class dig into some things, and this year we kind of revamped it a little bit. So I'm going to grab just a couple of highlights from the current set of ag finance information. Some of it's only available nationally, but some of it you can dig down and get a closer look at the 9th district, the Dakotas, Minnesota, the UP, and whatnot. So some of it's specific to the Minneapolis Federal Reserve District, and I'll try to point that out. So, but the data all comes from, or some of these snapshots come from, the ag finance updates. So you'll see we get this national survey of terms. Those are national, and the call bank call report data is also national, and the last one gets down into stuff specific to, or can be specific to, the 9th district or the Federal Reserve District. So that's where I'm gathering some of this information. I'll just hit some high points here. Looking first at the survey of terms, this is national in scope. The average feeder cattle loan was $104,000 in the third quarter of 2022. That's a sort of an all-time high for that particular category. So if you think about cattle prices have increased, or feeder pig prices have fluctuated over time, the average dollar amount borrowed is now $104,000. There's not a similar breakout. I wish there was. There's not a similar breakout showing the average loan volume for a real estate loan transaction. It's reported differently, and I haven't figured out how to back that particular piece of information out. Another thing, and looking at the raw data is interesting. I encourage you to do that, but just grabbing a different piece of information here. The second bullet or set of bullet points there is the average machinery loan has shortened a little bit. That fluctuates a little bit over time. Currently it's 37.25 months. So yeah, sometimes it's 3 years, sometimes it's 4 years. I read that as it's about a 3-year loan. So average duration, or typical duration or length of time that a machinery loan might be taken out for might be 3 years. And then the last one on the tab there, or from a tab in the spreadsheet that you have to like jump through some hoops to take a look at, but the interest rate, average interest rate charged nationally on loans for feeder animals. So the average feeder loan bottomed out, or hit its low point, in the third quarter of 2021 at 2.9%. So it depends on the type of loan and what you look at, but to look for where did rates bottom out. For feeder loans in particular, it bottomed out in the third quarter of 2021 at 2.9%. So that'd be an average across all borrowers, as reported by the bankers, ag bankers, for that quarter or for that time period. Since then, the rate on all loans has jumped almost 2% year over year, or within the last 12 months. So from that 2.9 in the third quarter of 2021, you're looking at 3, 4, 5% would be more typical right now. That's before the latest set of increases. So that's just some observations from the survey of terms, seeing those loan volumes grow over time. The second set of reports from that is the call report data. So some of this is summarized nicely. I have played around in the past and pulled out similar types of information directly through the different through the FDIC and other ways of analyzing or pulling apart the call report data. So you can find aggregate information in different ways. So, but specific to this particular set, did pull out that the real estate loan volume. So commercial ag banks lending to farmers and ranchers, that loan volume is up to $109 billion. So that would be a nominal all-time high. And the breakdown shows that ag banks, all commercial banks, so the large banks and ag banks have $109 billion. Ag banks, so think of your local agriculture bank, not one of the biggest commercial banks. Ag banks have 41% of real estate and 42.5% of non-real estate loans. And then also out of that call report data, oh, and by the way, I've been working from home as campus has been closed, so all the wonderful embellishments on the back of my slides, I just mirrored a snowstorm. So I look out my window and that's what I see, white. So I didn't have the wherewithal to make the slides all pretty up for this presentation. Sorry about that. My class would say, hey, that's pretty normal. Your slides are boring. The last slide on there, or last bullet point in this group, also shows that we hit some recent lows in the first quarter of 2022. So the beginning of calendar year 2022, the loan to deposit ratio for ag banks was 65%, and the net interest margin hit a recent low of 3%. So what does that loan to deposit ratio mean? That means that farmers and ranchers, for example, or farm households had plenty of cash, had money on deposit versus borrowed, and that drove the loan to deposit ratio, or it's one way of explaining a loan to deposit ratio for ag banks being at a very, very, very low level when all the bank's funds are pushed in a different way. Farmers don't have cash. Farmers are borrowing a lot of money for operating loans and land loans and every other purchase they make. Their deposits go down and their loan amount, or amount of loans borrowed, goes up. That gives you a very high loan to deposit ratio. Still doesn't say anything about the overall quality or health of the sector or anything else, but just in real general terms, that's what would drive the ratio up or down. So the relatively good position of the farm sector and the fact that banks in general have been had more than adequate deposits as of late. In the ag banks in particular, the loan to deposit ratio was relatively low at the beginning of the year. The net interest margin, that's the spread, that's the markup that a bank would charge in excess of what they're paying for funds. And that net interest margin historically has been much more like 3.5% to 4%, and that too bottomed out at about 3% in the first quarter of 2022 and has increased somewhat since then. So that's what I gleaned, and that's what seems to be going on. As interest rates increase, that's going to do a little bit more to play with the loan to deposit and net interest margins. The other thing I wanted to highlight was a breakdown or just showing an example of diffusion indexes, in part because of the change in the way that the ag finance information is reported. Not the way it used to be reported in the data book, but the way it's presented, reported now. You're much more likely to see a diffusion index of what's going on with some of the survey data of the ag bankers. So the class found this, I think, a little bit instructive, so I thought I'd share this as well. So what is a diffusion index? Diffusion index just takes a a survey. So if you surveyed 100 bankers, what percent of them or what share of them said, this is what we see as far as an increase. This is the percent of respondents who say this was no change. And here's the percent of respondents that say this was a decrease in the numbers. So if you have the raw survey data, you can see that 28% of your respondents said this, and 42 said that, and 31 said this. You can build your own diffusion index. Absent that, you sort of have to say, okay, what is the diffusion index and how do we interpret that? Or what's another way of saying this is what's going on? So in the in the latest survey, this is from the 9th district. In the 9th district, there was one category that they give the breakdown for. It's the percent of ag lenders who said that there's a decrease in loan demand and the share that said there's an increase in loan demand. So that second or third bullet point there says 45% of ag lenders in the 9th district said there's lower loan demand, less demand for borrowed money in that most recent quarter. It also gave the share that said 27% said there was an increase in loan demand. It's a big area. Could have been hog farmers in one spot or wheat producers in another spot that helped determine where there was an increase or decrease in loan demand. So taking 100%, subtracting 45 and subtracting 27 leaves, or by deduction, you have 28% with unchanged loan demand. Then we can build a diffusion index. A way, or one of the ways that the Fed seems to be consistently reporting the diffusion index right now is they take the share of increase and multiply by 200. They take the share that's unchanged, multiply by 100, and they take the share decreased and multiply by 0. So doing that math, you see that you get the 4,500 plus 2,800 plus 0, you get 8,200. You divide that by 100 to get to a base, and you get a diffusion index of 82. So it's a long way of saying that more lenders see a decrease in loan demand than an increase in loan demand. That 82, just to show you that the math works or comes out, here's a demand for loans, Minnesota or the Minneapolis district. So follow this column down here to the bottom left-hand corner, and you can see the 82. We'll get my little laser here. So see this 82 down here. In the third quarter, 2022, demand for loans was less than 100, or a diffusion index level of 82. To see that a little bit differently, I grabbed some of the diffusion indexes and went back to sort of this close to the start of the sample here. So here we've got 3 diffusion indexes for the 9th district. So the district South Dakota is in from the beginning of 2020, beginning of 2002, just about the beginning of this data series until the most recent quarter, the third quarter of 2022. So when you see these indices above 100, that means more of an increase than a decrease. And whenever you see this closer to 0 or further away from 100, and 100 would be going right down the middle of this chart. So anytime we're above the 100 line, you're seeing a decrease in these things. Anytime we're above it, you're seeing an increase in these things. So focus on this period right here from 2012 through 2016. What was happening? You went off of big increases and high levels of farm income and household spending and capital spending, buying more machinery, following this boom from 10, 11, 12, pretty good years for the area in terms of farm profitability. And then there was this concern about things turning around for quite a while in 15, 16, 17, diffusion index went down, and then to move this over, the recently or a few years back, we had a switch from concern about what's happening with farm income, what's happening with farm household spending, what's happening to farm level capital spending. That switched around here, third quarter of 2020. And it's been positive, or very positive here for a little while, until very recently, where the capital spending had turned down a little bit. So higher interest rates would be part of that. And then this was also continue to see sort of a surprise at the aggregate level, national level especially, of income, farm income moving higher or surprisingly higher from beginning of fall to the end of fall. The ERS adjusted all of its income levels up, or farm income levels up, for the farm sector. So that's what's happening with diffusion indices. Interest rates are the other piece that's held in the held in this data set. Switch off the laser here. So if we look at this on the left-hand side here, we've got farm level interest rates charged by ag banks averaged for the 9th district, and I just included everything. So down here on the bottom, you can see you've got fixed operating loan, fixed intermediate loan, fixed real estate loans, variable operating intermediate, and real estate. They all follow a similar pattern. Dips in 2002, 2003, the last time of a very sharp, steep interest rate increase or Fed tightening was in that 04 to 07 period, and then gradual declines, slight tightening here, followed by the pandemic, and then now the most recent tightening going on. It's a little busy, I get it. Let me zoom in for you. Recently, just to see the breakdown, for the most part, what I took away from this is variable real estate has the lowest level of interest, and a fixed operating loan has the highest level of interest. Let's ignore that noise and just look at operating fixed and real estate fixed, just to see, oh, when the Fed tightens, those higher rates tend to get passed on to farmer borrowers as well, like happened in 04. Rates went from 6.5 up to about 9%, and the tightening back here took rates from close to 5 to about 6.5, and then they fell here, and now the sharp increase. So that's one set of things going on. The other way we looked at this, or I challenged my class to look at this a little bit more, was to look at the cost of funds. For that, we switched gears and we looked at the farm credit system funding cost indices. Yeah, why not? So this is a mess. The dark blue line at the bottom is the overnight interest rate, and the bright green line is a 30-year funding cost. So basically, the farm credit system issues bonds, sells bonds to investors, uses those funds to fund ag banks that fund farm credit banks that fund farm credit associations. So this is the driver behind rates charged and interest expense for the Farm Credit Services of America, the single largest ag credit association, farm credit association in the country, that also serves the Dakotas. So here's what's going on. This is a snapshot of what their cost to issue bonds looked like over the last 20 years. So back in 2003, the overnight rate charge was close to 1%. And then when the Fed raised rates, that cost jumped from 1% up to 5%. So that's the effective impact, was a 4% jump in the overnight or short run cost of funds. You can see how that's fluctuated over time, and a long period of almost or near zero interest rates, for the most part. It's not where all the funds come from, but it does reflect what happened with commercial banks. Short run interest rates, interest paid on deposits, went very close to zero for quite a while. Other thing that's happening, that's now changing, if we look at the top line, the cost to issue 30-year bonds, that has slowly and steadily fallen, and reached this very, very, very all-time low in 2020, down under just over 2%, 2.3%. And now all the interest cost, short run, intermediate, and 30-year bond costs are all responding to this round of Fed tightening, and it's moving the overall cost of funds much higher. Ugh. All right, that's a lot. I'm looking at the clock. I should stop and just take questions.
Okay, well, thanks, Matt. Thanks, Jack.